Welcome to the Authority Hub podcast. I'm Nolan, joined as always by Claire.
And today we're featuring the expertise of Ana Cruz, mortgage broker in Burlington, on.
If you're self-employed in Burlington and your accountant has done exactly what they're supposed to do, kept your taxable income low, why does that same smart tax strategy suddenly become the reason a bank won't approve your mortgage?
That tension is real, and it catches a lot of people completely off guard.
Let's set the scene, because this is a situation Ana Cruz sees regularly in Burlington.
A contractor, incorporated, 2 years in, genuinely profitable, goes to their bank to buy a home.
They have a down payment. They have clients. The business is real and the cash flow is real.
But the bank looks at the notice of assessment, sees the net income after all the legitimate deductions, and the number doesn't clear the threshold.
And the borrower is sitting there thinking, I know what I make. Why doesn't this work?
That moment is disorienting, and Ana Cruz talks about it directly. A bank decline doesn't reflect the full picture. It reflects whether you fit a specific checklist.
So let's talk about why the standard system produces that outcome, because it's not random.
The core issue is structural. Lenders, the major banks, are governed by federal qualification rules, including the stress test, and they rely almost entirely on net income from tax returns.
Typically 2 years of returns, averaged.
So if you've been incorporated for 18 months, or if your deductions, depreciation, CCA, legitimate business expenses, have reduced your taxable income significantly, the bank's calculation simply doesn't capture what you actually earn.
And this is a feature of the tax system working correctly, not a sign that something is wrong with the borrower.
Exactly. The Canadian tax system rewards business owners for reducing taxable income. The mortgage qualification system, at the A lender level, penalizes them for it.
So what does Ana Cruz actually do differently for a file like this?
The first thing she does is ask a different set of questions. Not just what the T4 says, but how income actually flows. Through the corporation, through contract work, through a combination.
Because many self-employed borrowers have more qualifying income than their tax documents show, and the right lender framework can account for that legally and accurately.
That's the key phrase, the right lender framework. Canada's mortgage market operates in tiers, and Ana Cruz works across all of them.
Walk us through those tiers, because I think a lot of people don't realize how much exists beyond the bank.
So lenders are the major banks and federally regulated credit unions. Strictest criteria. Stress test applies. Net income from returns.
Then there's the B lender tier.
B lenders, trust companies, monoline lenders, apply their own criteria and have significantly more flexibility for self-employed borrowers. Some will use an add-back approach, taking the stated net income and adding back business expenses that don't represent actual cash outflows.
Things like depreciation, capital cost allowance, expenses that reduced taxable income but didn't actually leave the borrower's bank account.
Right. Others will use a stated income program if the credit profile is strong enough. And then there are private lenders, who operate outside the institutional framework entirely and typically lend based primarily on the equity in the property.
So the question isn't just, can I get a mortgage? It's, which tier of lender is actually the right fit for this specific file?
And that's where Ana Cruz's work as a mortgage broker in Burlington becomes the actual value. It's not about finding the lowest rate. It's about finding the right structure.
Let's go back to that contractor scenario. What does the path forward actually look like?
It depends on 3 things Ana Cruz identifies as the questions that change the conversation: income structure, timeline, and the property itself.
Income structure we've covered. What about timeline?
Timeline is about whether this is a permanent solution or a bridge. A private mortgage at a higher cost structure makes sense if the plan is to refinance into a B lender product in 12 months once the income documentation is stronger.
It doesn't make sense as a long-term hold. The 5-year picture is a different conversation than the monthly payment.
And the property question is one borrowers often overlook entirely. Lenders assess risk at the property level too: a rural lot, a mixed-use building, a condo with a status certificate issue can all affect which lenders will touch the file.
Knowing that before the application goes in protects the borrower's credit from unnecessary hard inquiries.
Which is a real cost. A poorly sequenced application, wrong lender first, decline, reapply. Can damage the credit file and reduce the options available.
And this is where the broker role in an alternative file is genuinely different from a standard transaction.
Ana Cruz describes it as two roles, advocate and file architect. Alternative lenders, particularly private lenders, make decisions heavily based on how a file is presented.
The same borrower with the same income and the same property can get a very different response depending on whether the file tells a coherent story.
That story includes the income documentation, the rationale for the loan amount, and critically, the exit strategy. How does this borrower move to a better product at the end of the term?
Let's talk about what that exit actually looks like in practice, because I think this is the reframe that matters most.
The most important reframe in alternative mortgage solutions is that an alternative mortgage is often a tool, not a permanent state.
For a lot of Burlington borrowers, the right alternative product today is a bridge to a conventional product, typically a 12 to 24-month term.
So take that contractor. B lender approves them, they're in the property. During the term, they make every payment on time. They let their income documentation build. Now they have 2 years of returns showing the full picture.
At renewal, they have a clean payment history on the mortgage itself, stronger documentation, and potentially a meaningfully better product tier available to them.
The planning conversation is about knowing the exit before you enter. What needs to change between now and renewal for this borrower to qualify somewhere better?
Is it the credit score? The income documentation? The equity position? Each of those has a specific, actionable answer.
And this applies beyond self-employed borrowers too. Ana Cruz works with clients navigating bruised credit, life transitions, separation, inheritance, estate sales. Situations where the standard bank process simply can't accommodate the timing or the complexity.
Bruised credit is worth spending a moment on, because there's a lot of misunderstanding about what it actually takes to move forward.
Some borrowers assume a past credit event permanently closes the door. Others assume time alone fixes it. Neither is quite right.
B lenders typically want to see a meaningful period of re-established credit after something like a consumer proposal, with a minimum credit score that varies by lender.
Private lenders are generally less focused on the score itself and more focused on the loan-to-value ratio. How much equity is in the property relative to what's being borrowed?
And the trajectory of the credit score matters more than the number in isolation. A 620 that's been climbing for 18 months tells a different story than a 650 that's been declining.
Lenders look at the pattern. That's a detail that Ana Cruz, as a mortgage broker in Burlington working regularly in the alternative space, brings to every file.
Let's bring this back to the outcome, because I want listeners to hear what actually becomes possible.
The contractor we started with, the one the bank said no to, has a path. It might be a B lender with an add-back calculation. It might be a stated income program. It might be a short-term private mortgage while the income documentation catches up.
The client closes. That's the outcome. Not someday, not after years of waiting. With the right structure, the right sequencing, and the right lender tier, the client closes.
And during the term, they're not just holding a mortgage. They're building the file that gets them to a better position at renewal.
The family stays in the home they planned for. The business owner isn't penalized for running their business correctly.
The number on the notice of assessment stops being the whole story.
Here's the truth that generalizes beyond any single file. A bank decline is the beginning of the conversation, not the end of it.
Canada's mortgage market was built with multiple tiers for exactly this reason, because not every legitimate borrower fits a single framework, and fit is about the right match, not failure.
If you're in Burlington and you've heard no from a bank, or you're self-employed and you're not sure where to start, Ana Cruz is the broker to have that conversation with.
You can find her full profile at askanacruz.ca, and her approach to strategic mortgage planning is exactly what we've been describing, the whole picture, not just the rate.
Ana Cruz is a mortgage broker in Burlington specializing in alternative mortgage solutions.